Are NFTs a fad, or the future of digital collectibles? How's it going, everyone? My name is Dan, but you can call me Malone. And did you know that in 2021, over $40 billion worth of NFTs were sold? To put that number into context, the total value of the global art market last year was $50 billion. NFTs in 2021 were almost as valuable as global art. Mike Winkelmann, better known as Beeple, sold a piece of digital art for $69 million last year. And Twitter co-founder Jack Dorsey sold his first tweet as an NFT for nearly $3 million. Clearly, NFTs are garnering lots of attention. So let's discuss what they are, why they're popular, their investment potential, and their future. By the end of the video, you'll be much more in the know with NFTs. And all I ask in return is that you leave a like and subscribe to the channel for more personal finance content. Thanks for doing that, and let's get started. NFT stands for non-fungible token. If something is fungible, it's said to be interchangeable or replaceable. For example, this €2 coin is fungible because it can easily be replaced by another identical €2 coin. Even cryptocurrencies like Bitcoin and Ethereum are fungible. €1 will always equal another euro, just like how one ether will always equal another ether. Therefore, something that is non-fungible is not interchangeable or easily replaced. Physical non-fungible items have existed for centuries in the form of fine art, rare historical items, or collectibles. Up until recently, non-fungible items couldn't exist in the digital world because it was hard to prove their authenticity. In the age of technology, digital images can be screenshotted, videos can be downloaded, and songs can be saved. So how can we identify the original true copy of a piece of digital media? This is where blockchain technology and non-fungible tokens come in. A non-fungible token is a way to record, verify, and track the ownership of a unique asset. Central to NFTs is blockchain technology. The blockchain records transactions and tracks assets within a digital network. In effect, it acts as a proof of ownership over the digital asset or NFT. Photos, videos, music, and even concert tickets all have the capacity of being turned into NFTs using blockchain technology. It's important to understand that NFTs are not cryptocurrencies. Interchangeability and the lack thereof is what separates NFTs and crypto. NFTs became extremely popular in 2021. The research paper, The Non-Fungible Token Market and its relationship with Bitcoin and Ethereum, found that between January and April 2021, the average daily trading volume of NFTs was $6.2 million. Every day, $6.2 million of NFTs trading hands. That figure was $180,000 in 2020, giving a 34 times higher trading volume in early 2021. OpenSea, the world's largest NFT marketplace, just raised $300 million in Series C funding, giving them a valuation of over $13 billion. Just 6 months ago, OpenSea was valued at $1.5 billion, so they've increased nearly 9-fold since then. The popularization of NFTs has been aided along by celebrity ownership, with the likes of Jimmy Fallon, Eminem, and Steph Curry owning items within the Bored Ape Yacht Club. This particular NFT collection just passed $1 billion in total sales after launching in April 2021. CryptoPunks, one of the first NFT projects created back in 2017, gained significant traction in 2021, with owners including Gary Vee, Logan Paul, and Mr. Beast. The cheapest punk in this collection of 10,000 will cost you nearly $240,000. Both of these projects have a common denominator: exclusivity. NFTs are attractive because they're a form of clout. Their value is derived from perception. This is why marketing plays such an important role in a successful NFT project. But from an NFT creator standpoint, there's tons of value. You have total control over supply. You can earn royalties every time your NFT is sold, and you can access a global marketplace without the need for intermediaries, like art galleries for artists or record labels for musicians. One of the biggest proponents of NFTs has been Gary Vaynerchuk, to the extent that Vayner NFT is now a subsidiary of the VaynerX brand. Gary's outlook on NFTs is clear. He believes the market is viewing NFTs as a 30-day opportunity, which is why 99% of projects will likely fail in the short term. But in the long term, he sees NFTs as a 30-year opportunity that can build brand value while also delivering community value. This is something that we're already seeing in projects like Axie Infinity, which is a super cool use case for NFTs. Axie is the #1 game on Ethereum and essentially operates as a player-owned economy where you can earn in-game resources that will have real economic value. The game has its own currency called AXS tokens, and the holders of these tokens essentially dictate how the game should be developed. All of the in-game items and resources are NFTs, and players can also create their own mini-game NFTs with the ultimate goal of fully decentralizing the game creation process. So the popularization of NFTs goes beyond a linear view of just selling digital art. Instead, it's the ability to reinvent existing industries like gaming that has people excited. But what do NFTs look like as an investment opportunity? Most NFTs are Ethereum based, meaning that they're bought and sold using Ether. Therefore, a fall in the value of Ether will implicitly result in lower investment returns on NFTs. Conversely, an increase in the value of Ether will result in higher investment returns on NFTs. So to participate in the NFT marketplace, you need to believe in the future of not just NFTs, but also Ether. The same principles apply to investing in stocks, which are denoted in a currency which is different to your home currency. The research paper, The Non-Fungible Token Market and its Relationship with Bitcoin and Ethereum, found that a Bitcoin price shock triggers an increase in NFT sales, whereas an Ether price shock reduces the number of active NFT wallets. The results of the study suggested that cryptocurrency markets affect the growth and development of NFT markets. This adds an extra layer of risk into NFT investing, considering the volatile nature of cryptocurrencies. A separate research paper, Non-Fungible Tokens, the Analysis of Risk and Return, looked at NFT startups listed on the cryptocurrency exchange and their return on investment. The research found that NFT startups are, unsurprisingly, significantly more volatile than the average S&P 500 company. Furthermore, 60% of NFT startups in the study delivered positive returns, and over half of these earned returns in excess of 200%. But again, this comes at the cost of heightened volatility. We also need to consider the time at which NFTs boomed. We've been in an everything bubble since March 2020. Trillions of dollars and euros in fiscal support has resulted in lots of excess cash swirling around in the economy. Some of that cash inevitably ends up invested in stocks, cryptocurrencies, and you guessed it, NFTs. The investment thesis around NFTs is totally speculative. NFTs are a non-productive asset. They currently are how they always will be. Their valuation is based on market sentiment, and you purchase them because of your expectations for future gains. Therefore, in the short term, NFTs represent a gambling opportunity rather than an investment opportunity. In the long term, who knows? The future of NFTs is largely unknown. NFTs remain an esoteric asset class in the sense that NFT marketplaces like OpenSea require buyers to purchase NFTs using crypto. Therefore, NFTs are, by proxy, reserved only for those who understand the ideologies of crypto. There's also a myriad of issues and unanswered questions surrounding NFTs. The first issue is NFT wash trading. Smart contracts are central to the buying and selling process of NFTs. The contracts provide certainty of outcome in the sense that they won't execute until all parts of a particular transaction are fulfilled. However, it's possible to use these contracts in such a way that creates artificial buy and sell transactions. This is problematic because a single NFT seller, or both a colluding buyer and seller, can enter into fictitious transactions to mislead the market and inflate the price of an NFT. The second issue is forgery, fraud, and overall security. NFTs don't offer the same ownership exclusivity rights as physical non-fungible items. They can be distributed, reproduced, and viewed without consent. However, for NFT owners, this really is just part of the game. Sure, someone could screenshot your NFT and upload that screenshot as an NFT themselves, but that's not to say it will be successful. NFTs cost fees to make, requiring an outlay from the outset. On top of that, your original NFT is likely part of a unique collection, which gives it value. The screenshot equivalent does not have that luxury. On the topic of ownership rights, the authors of the research paper Non-Fungible Tokens, Blockchain Scarcity and Value made the point that artists can retain the copyright to a piece of art even after an NFT of that art has been sold. It's entirely possible for the artist to create another NFT underpinned by the same art, therefore reducing the value of the original NFT purchased by the buyer. I can only imagine that the legality of this practice will be challenged as the space develops. The final issue worth mentioning is the likelihood of an NFT 404 error code. NFTs reference a particular digital file, files which are stored in centralized servers. It's totally possible that the locations where these files are held could disappear or relocate. Over 20 years, 98% of internet links turn dead, which is known as link rot. So while your ownership of the NFT won't disappear, your ability to view it just might. OpenSea now gives artists the option to store media files on Arweave, which is a decentralized permanent storage network. This tackles the 404 error problem and has been used by the likes of Gary Vee for his VeeFriends NFT collection. In consideration of all we've discussed, I'm personally very excited for the future of NFTs. The paper Non-Fungible Tokens, the analysis of risk and return, made the point that it's more efficient to trade assets if the ownership of those assets can be instantaneously proven and transferred quickly and securely for a near zero fee. One of the largest non-fungible asset classes in the world is physical real estate, but the process of buying and selling real estate remains quite arduous. There's legal consultations, valuation specialists, real estate agents, and even more intermediaries. But if instead you create an NFT of a physical property, all of a sudden ownership is instantaneously proven. This opens up the possibility for a more globalized real estate market, fractional ownership of physical properties, and many passive income opportunities. While we're definitely in a state of NFT mania at the moment, I do agree with Gary Vee in the sense that NFTs could represent a 30-year opportunity, and we've likely not yet seen its true potential. Let me know what you think about NFTs. What projects are you excited for, and what do you think the future holds for this technology? So I really do hope you enjoyed the video here today. As always, if you did enjoy the video, please do let me know in the comment section below. Leave a like on the video, subscribe to the channel, and I'll see you in the next one. Cheers.